Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to part 3 of what is now going to be my 4-part video series on Roth IRA conversions. And this video, this is where things are going to start getting fun, because as promised in this video, we are going to start crunching numbers in TurboTax, and then we are going to cover how to estimate your future RMDs. Because, as you know, one of the major reasons to do Roth IRA conversions in the first place is to avoid, or at least to attempt to minimize, the impact of RMDs in your silver years. So let's start by looking at a timeline, and then we are going to hop into the examples. So right here I have a timeline with 2 relevant ages on it. The first one is 59 and a half, and as many of you know, if you take a distribution from a traditional IRA before you turn 59 and a half, you can get dinged with that 10% early distribution penalty unless you have a valid exception. But in general, you're going to get dinged if you take an early distribution over here before age 59 and a half. And we're going to talk about how that may impact your Roth conversion planning in a few moments. The other relevant age here is 73. And as many of you know, I'm going to go right down here to the horse's mouth, irs.gov. Beginning in 2023, the Secure 2.0 Act, which is an act that I mentioned in previous videos, raised the age that you must begin taking RMDs to 73. So right here, this is our RMD territory over here. This is our early distribution territory over here. And so we're going to look at these 3 buckets, this bucket, and then this bucket of time over here. By the way, if you enjoy this video, please like and subscribe and let me know in the comments what's going on in your tax planning situation. So here's the timeline again. I'm going to call this bucket of time right here the sweet spot. This is about 13 years, 13 and a half years. This is the sweet spot for Roth conversions that we're going to look at in this video. Now, before age 59 and a half, you can do Roth conversions, but you have to make sure to pay the tax on the conversion with outside funds or funds from another source, or you're going to get hit with the 10% early distribution penalty on the part that goes to pay the tax. Not the part that ends up in the Roth, but the part that goes to pay the tax. So, for example, if you do a $10,000 conversion here and you pull $2,000 of that out to pay the tax, I'm just using round numbers, and $8,000 is left to go into the Roth, then you will get dinged on that $2,000 with an extra 10% penalty. So you can still do conversions here, and often they can be beneficial to you, but you just have to make sure to pay the tax with outside funds. Otherwise, the 10% penalty could really eat into the benefit of doing the Roth. So it's something you have to be aware of and you have to consider if you're doing conversions here. Now, within the sweet spot, you have the ability to pay the tax using money from the IRA distribution itself without the 10% penalty. So again, if you did the $10,000 conversion, you use 2 to pay the tax, 8 would go into the Roth. There'd be no penalty on the 2 that went to pay the tax. Ideally, you would want to pay the tax with outside funds here anyway, because the more money you can stuff into the Roth, the more can grow tax-free for the rest of your life and then can transfer to your beneficiaries. They will still have to take the money out over 10 years, but there won't be any tax on it once it's in the Roth. So it's best to pay with outside funds the tax if you can, but sometimes that's not always going to be possible, and you still may find benefit in doing the Roth conversion, even though you have to use some of the money that comes out of that traditional IRA to cover the tax. Now, after 73, you can still do Roth conversions here, but you will already have a base level of required income, basically, that's coming from those RMDs that you no longer can defer. So RMDs is already going to push you up potentially into higher brackets. So if you do a Roth conversion here, you're already you potentially may already be in higher brackets. And so that Roth income is just going to be, the income that you have to pick up on your tax return from doing the Roth conversion will just be layered right on the top of all the other income and could potentially be taxed in your highest brackets. So for all the planning examples that we're going to be looking at, we really want to focus on this sweet spot right here. This is where generally people find the most opportunity to do Roth conversions. So let's jump into the examples. We're going to start simple, and then we're going to layer on complication after complication. So let's jump in. All right, example number 1. We're going to start with the simplest case. Let's say you and your spouse are going to live on assets for a year. Maybe you take a sabbatical, maybe you go back to graduate school, maybe you get an inheritance and decide to live off of that for a year. Doesn't really matter what the reason is. Whatever the reason, the key point to this example is that you have no income to report for that particular year. You're going to live on assets. And let's just say you also have a traditional IRA with money in it. How much Roth conversion can you do completely tax-free? And the answer is you can do Roth conversion up to the standard deduction of $25,900 for 2022. This is a married filing joint standard deduction. And then the amounts are indexed for inflation over time. All right, so let's jump into TurboTax. I'm going to put in a $25,900 Roth conversion, and we're going to make sure that the result is zero tax. All right, so here we are in TurboTax. I'm on the Personal tab. I'm in the Personal Income section. I'm going to scroll down to Retirement Plans and Social Security. This is where we're going to enter information about Roth conversions. Right here under IRAs, the 1099-R. This is the form that you will get if you do a Roth conversion, so we're going to update that section right there. Did you receive a 1099-R? Well, we will if we do a Roth conversion. We're going to type in the information ourselves. Okay, tell us which 1099-R you have. The most common one is going to be this first one. This is when you take money from a 401k, retirement plan, pension, and IRA. These other ones here are pretty specific to certain individuals, so we're just going to go with the first one, continue. And then right here, this is where we're going to enter the information. So I'm going to put in a gross distribution from a traditional IRA, which is what a Roth conversion is, of $25,900. Remember, I'm working in the 2022 edition of TurboTax because as of the making of this video, some of the modules in 2023 actually are still under development, so they're not ready to be used yet. This video is being made right at the end of 2023, so we're going to use 2022. Concepts are the same. So this is the distribution from the traditional. Generally, you will find that this box is going to be checked taxable amount not determined, and by having this box checked, TurboTax will make this a taxable number automatically. You don't actually have to type anything in right here. And usually this is checked because your broker or whoever is the custodian of your IRA is either not going to know how much is taxable or they don't want to opine. So they're just going to check this box and they're going to leave this box blank, which is fine for our purposes. We're going to check this box here because this is an IRA. And I'm going to select a code. I'm just going to say that this is a normal distribution because we are above 59.5 for this example. And so let's see what happens. So I'm going to go over here to the forms view. We're going to be working in here a lot so we can really see the impact of what we're doing. I'm going to click this. We're going to go over to forms and I'm going to find the 1040, which is right here. And then we're going to scroll. Let's see, we're going to scroll down here on the 1040, and what we should find is right here on line 4A. This is your IRA distribution line. If you had a non-taxable amount, it would go here in 4A. The taxable amount will go in 4B, and that's our $25,900. We go down here. Our adjusted gross income is $25,900. Our standard deduction for 2022 is $25,900. Our taxable income is 0. So let's go back to the spreadsheet. So in this simple example, right, that would be, let's say, $25,900, which you had put into a traditional IRA. It was tax-free or tax-deferred. You didn't pay any tax on it at the time when you put it in the traditional. it was converted into a Roth IRA tax-free, because in this example, we had no other income to report, so we were able to convert all the way up to the standard deduction for 2022, tax-free. So this income, this $25,900, will never be taxed. This $25,900 legally escaped taxation completely under the facts and circumstances of this example. So I want you to understand, in this, the most basic case, the simplest case, you could potentially do a Roth IRA conversion of this amount, or whatever the indexed for inflation standard deduction amount is for the particular year that you're working on, and that would legally escape taxation completely. Now, this is an extreme example, which certainly does not apply to everybody, but it does drive home a major theme that I want you to take away from this video, and that is doing Roth conversions in your lowest tax bracket / tax rate years is going to be the most beneficial. We want to convert at the lowest possible rate, and as we get into more complicated planning in a few more slides, we're going to identify areas in the lower brackets to try to do conversions in. But this extreme example where it's like, if you don't have any other income, your lowest bracket is 0 essentially, and you could convert up to the standard deduction and never pay any tax on that money. So we're going to look for opportunities throughout our lives, facts and circumstances, to find these low rate conversion opportunities. All right, example number 2. So let's layer on a long-term capital gain to this scenario. So assume that your spouse bought stock years ago for $100,000. It was sold this year for $183,350, resulting in a long-term capital gain of $83,350. Now you're tax savvy. You know that the top of the 0% long-term capital gain bracket for 2022 is $83,350. We're still working with 2022 here, but this number will be indexed for inflation each year, just like the normal tax brackets. So you brag to all your friends that you're pocketing $83,350 of profit at 0 tax. You're happy as a clam, and you decide that to make this year even better, you're going to do some Roth conversion, and you're going to convert up to the standard deduction of $25,900. Will the $25,900 of Roth conversions continue to be completely tax-free in this situation? And the answer is yes, it will. In this case, it will. Now let's go into TurboTax to confirm that. All right, so we're back in TurboTax. I'm on the Personal tab again, Personal Income. I'm going to scroll down here until we can find Investment Income. There's the Roth conversion we did in the last example. Investment income, stocks, mutual funds, bonds. I'm going to update that section. Did I sell any investments? Yes. Did you get a 1099-B? We would. I'm going to type in the information myself. Continue. It's going to make me pick a brokerage in order to continue. I'm going to enter one sale at a time. Here's the information. I'm going to type all this in, and then we're going to continue. Okay, so we have stock sale. It was purchased in a prior year. It was sold in the current year. $183,350 was the sales price. $100,000 was the cost. This should be enough for us to see what's going on. So I am going to go back to the Personal tab first, and we're going to go make sure that this gain is in here. I'm going to scroll down. There it is right there. So there's our $83,350 of long-term capital gain right here. Here is our IRA conversion of the Roth IRA conversion of the 25.9. Okay, so these are both in there. Let's go to Forms View. All right, so I'm back on the 1040. Let's scroll down and see what we got. So right here we should see there's our Roth IRA conversion of the 25,900. There is our capital gain of the $83,350, giving us total income of $109,250. There's our standard deduction of the 25.9, same as last time. So our taxable income is $83,350, the amount of the capital gain, and our tax is 0. Why is our tax 0? Because the top of the 0% capital gain bracket for 2022 was $83,350. So we're still at 0. Let's go back to the spreadsheet. So what do we have? We have $25,900 of ordinary income from the Roth conversion. That goes against the standard deduction of $25,900, leaving ordinary taxable income of $0. Then we have the $83,350 of long-term capital gain, which is the maximum amount for 2022 that is taxed at the 0% rate. Here are the long-term capital gains rates for 2022. Right here, married filing joint, 0% rate. Taxable income under $83,350 gets taxed at 0. Now, that seems pretty straightforward. So far, we have a capital gain and we have a Roth conversion, $0 of tax. Now, let's get tricky. All right, example number 3. So same fact pattern with the long-term capital gain as in example 2. We had it purchased for the $100,000. We're selling it for the $183,350. There's going to be a capital gain of $83,350. So that information is the same. However, instead of doing just a $25,900 Roth conversion, you decide you're going to do a $125,900 Roth conversion. Here are some tax tables for 2022. So on the left, these are the ordinary income tax tables, which you've seen me use in the other videos. Married filing joint, here's the brackets right here. We also have the 2022 capital gain brackets. These are also indexed for inflation over time, so the concept will be the same in 23, 24, etc. So right here, here is the threshold, 83,350, where anything below that is going to be at the 0% rate. So how much tax are you going to pay on the $125,900 Roth conversion? Now, if you have watched parts 1 and 2 of this series, you might approach the question just like this. So step 1, we have our Roth conversion income of the $125,900. We have our standard deduction of $25,900. So we have taxable ordinary income of $100,000. And we're going to go down here to step 2. We're going to set up the brackets just like they were right up here. I'm going to take these down here and put them in this little table. So as you know, the first $20,550 gets taxed at 10%. You have $2,055 of tax. The next $63,000, and remember that what I did was I took the top of this bracket, the $83,550, and I subtracted off the $20,550, so that the difference between those two numbers is the $63,000 times 12% and gives you $7,560 of tax. And then the remaining amount to get to the total of $100,000 gets taxed in the 22% bracket for $3,619. The total of these three, $13,234. And if you did it that way, you would say my tax on the Roth conversion of the $125,900 is going to be tax of $13,234, which is right here. My long-term capital gain of the $83,350, that's still taxed at the 0%. So my total tax on the Roth conversion of the $125,900, considering this fact pattern, is $13,234. Is that correct? Is that the correct thing? Let's go to TurboTax and find out. All right, so we're back in TurboTax. I'm back on the Personal tab. We're going to scroll down to our Roth conversion. I'm going to update this one. I'm going to edit it. Yep, we're going to edit that one. And I'm going to, instead of the 25.9, I'm going to put in 125.9 right there. And then we are going to go back to, all right, so it started calculating some tax up here for us. We're now going to go back to Forms View. We're going to go back over here to the 1040. And now we're going to scroll down here on the 1040 to see what we've got. So now we have the $125,900 of the taxable amount for the Roth conversion. There's our $83,350 of the long-term capital gain. There's our $25,900 standard deduction. We get down here to $183,350 of taxable income, and it calculated tax of $25,737. That seems different than what we have on our spreadsheet. So remember this number, $25,737. Let's go back to the spreadsheet. So TurboTax has the $25,737. We have $13,234. What are we missing? And what we are missing is the thing that most people don't quite get about capital gain. And you have to be aware of this for your Roth conversion planning, because in this example, Roth conversion, the income that came from that Roth conversion of $125,900 is doing something to the capital gain that a lot of people don't seem to quite understand. So here is what it is. There's an ordering rule in the tax law. The ordering rule is that ordinary income comes first, it gets measured first, and then long-term capital gain income comes second, okay? The ordering rule does not say that these are two mutually exclusive things which have no relationship to each other. And a lot of people think that. A lot of people think ordinary income is completely unrelated to your capital gain. And so, but they're not. And that's the thing. And then you have to be aware of that, because if you're going to do a Roth conversion, you could have the potential of causing what we're about to go through right here. So here is how it actually works. I want you to think about ordinary income and capital gain income as kind of like two buckets that are stacked on top of each other. The green bucket here is going to be ordinary income. That gets measured first. The blue bucket is going to be capital gain income, and that gets measured second in what we're doing right here. So if the green bucket is equal to 0, and just assume that this means 0. If I was completely 0, you wouldn't even see it, so just assume that means 0. The blue bucket is 83,350. So we have 83,350 here, we have 0 here. The capital gain in that case has not exceeded the top of the capital gain bracket. So if this is 83,350 and the top of the bracket is here, then this has not exceeded the top of the bracket. However, as the green bucket increases in value, what it's going to do is it's going to push up the blue bucket. It's going to push the blue bucket up in this direction right here, meaning it will push the capital gain into the next capital gain bracket. The first capital gain bracket is 0. The second bracket is taxed at 15%. So if this number, if your ordinary income goes higher than 83,350 in this example, it's going to push the capital gain all the way into the 15% bracket. This capital gain will no longer be taxed at 0. It will be taxed at 15% because your ordinary income, which is measured first, pushed the capital gain into the next bracket. Okay, so again, if the green bucket ordinary income already exceeds 83,350, and remember this will be indexed for inflation, we're talking about 2022 thresholds here, all of the capital gain has been pushed up into the 15% long-term capital gain bracket. So let's do the math again. Now, this first part is the same. We had the Roth conversion income of the $125,900. Here's the standard deduction that goes against it, leaving $100,000 of taxable income. Okay, but now step 2, we're going to do the exact same thing here. The first $20,550 gets taxed at 10, the next tranche gets taxed at 12, and the final tranche gets taxed at 22%, giving us the $13,234. This is where we stopped last time. We said, oh, it's $13,234. But here's the next thing that happens. The long-term capital gain gets pushed up into the 15% bracket. So the 83,350, which was previously being taxed at 0%, is now being taxed at 15% because of the amount of Roth conversion you decided to do, which causes an extra $12,503 of tax. So step 4, when I add the ordinary income tax of $13,234 to the $12,000 as well as the $12,503 long-term capital gain tax, I get $25,737. Let's go back to TurboTax. There it is right there. There's your $25,737. That's why it was more than we expected. So that is potentially a cost of doing a Roth conversion when you are in the lower brackets. Doing a Roth conversion in this fact pattern caused an extra $12,503 in tax because it caused the long-term capital gain, which had previously been taxed at 0, to end up being taxed at 15%. So it's something to be aware of. Now, one thing I want to show you, and this is likely the reason why most people don't fully understand the relationship between ordinary income and long-term capital gain. If you look at this set of brackets right here, see how big this is? 83,351 goes all the way up to 517,200. What usually is the case is that people have ordinary income from wages, from business, from a variety of different sources, and it's usually more than this. You know, it's like maybe low six figures kind of a thing, but it's not anywhere near this number right here. And so what happens is they have already pushed any and all of their capital gain into the 15% bracket. So if they're already in the 15% bracket, then doing a Roth conversion doesn't cause any long-term capital gain that would have previously been taxed here to actually be taxed in the 15% bracket. And that's why they don't think that there's any relationship between the long-term capital gain and the ordinary income, when in fact there is. So if you're in the lower brackets and if you do have capital gain that is, you know, under this amount, it's something to just be aware of, and you have to make sure when you're deciding how much Roth conversion you want to do that you're not accidentally causing capital gain that was previously taxed at zero to move over into this bracket and be taxed at the 15% rate. If your ordinary income is already greater than the 83,350, which it is for most people, this is kind of what I just said, then your long-term capital gain is being taxed at 15% anyway, so additional income from a Roth conversion doesn't change that. It doesn't bump you up into the next long-term capital gain bracket, unless it's significant enough to bump you into the 20% bracket. If we go up here, if you happen to have income that is above this amount and there's long-term capital gain included in there, you could potentially bump up into the 20% bracket. Okay, so the concept of what we just went through is the same. More and more ordinary income and more capital gain will eventually push you into this bracket as well. All right, next thing we're going to do is start talking about RMDs. All right, in order to start talking about RMDs, I'm going to lay things out in what I call my personal tax planning template. So let's just kind of walk through it briefly. We'll start with the tax year starting in 2022 and going out into the future. We have our two taxpayers here. In this case, we're going to have Phil and Alice. They're a married couple, married filing joint. Phil is going to be 68 in 2022 and Alice is 67 in 2022. And the rest of this I've set up just like you would set up an income tax return, basically. I have W-2 income for years that they're working before retirement, interest income, dividends, income from Roth IRA conversions, inherited IRAs, Social Security, and then we're going to have IRAs that are going to be subject to RMDs. These are going to be our RMD rows right here. And you can see that Phil turns 73 in 2027, so his RMDs are going to start right here. And then Alice has two IRAs. She turns 73 in 2028 right here, so her RMDs potentially will start right here. And then, of course, I have all the other kinds of income that you could have. I have our long-term capital gain and qualified dividends section, other adjustments to income like business income, or if Phil and Alice are still deferring income into IRAs. Then we get down into our standard and itemized deductions and everything down here, and eventually we get down to taxable income and ultimately to tax. So this is how we're going to kind of set it up. And what we really want to do is we want to start thinking about what these potential RMDs are going to look like. And we're going to go into a calculation, how to actually calculate an estimate of what these RMDs are going to be in those future years. But we have to think about what are these going to do to my other income sources, for example? What brackets are these are these RMDs going to put me in? Like, for example, here's Phil and Alice collecting Social Security. I want to do an expanded example of this Social Security for a second, because just like when we went through the long-term capital gain area, and long-term capital gain that was previously taxed at zero suddenly got caused to be taxed at 15%, because we did a Roth conversion that created more income, RMDs are going to create income too. And so it could have an impact on Social Security. So I want to go to that example. Okay, example number 4. Let's say that you and your spouse each have $24,000 of Social Security income. That's what we just saw with Phil and Alice. Assume that between the ages of 67 to 73, that is what you are living on. The Social Security income is your only income for those years. With that in mind, how much of the total $48,000 of Social Security income is taxable? And the answer is none. Social Security income is not subject to tax when it is your only income. Let's throw the $48,000 into TurboTax and make sure that that is correct. All right, we're back in TurboTax. I'm on the Personal tab, Personal Income. I'm going to scroll down to Retirement Plans and Social Security again. This time we're going to go in here, Social Security. I'm going to click Update. Did you receive Social Security in 2022? Yes. Okay, here's where we're going to put in the information. I have Mickey and Minnie as the taxpayers in this example, but we're just going to assume that's Phil and Alice. So they each have $24,000 of Social Security income. Now that that's in there, let's go to the Forms view. We're going to go over here to the 1040, and we're going to scroll down here to see where that income shows up. And it's right here on line 6A, Social Security benefits. There's your total of 48. Taxable amount is 0. So we go down here and our tax is 0 because this is not subject to tax if it's the only income. So let's go back to our spreadsheet. But what causes Social Security income to become taxable? And the answer is other income, including income from RMDs. So for example, let's say in addition to the $48,000 of Social Security income, you and your spouse have a total of $70,000 of RMDs. Let's throw the $70,000 into TurboTax. Okay, we're back in TurboTax now. I'm going to go back down here to where we were before. Here's the IRAs, the 1099R section. I'm going to update that. Yes. Enter the information myself, continue, and we're going to go right back here where we were, and I'm going to put in $70,000 of income from RMDs. I'm going to click taxable amount not determined. I'm going to click IRA. I'm going to just say that's a normal distribution. Okay, and you can see that it's calculating some tax. So let's go back to Forms view. We're going to go back over here to the 1040. And we're going to scroll down here to make sure we see exactly what the tax number is. So here we go. Here's $70,000, the taxable amount of an IRA distribution right here. Now before, here's our total Social Security benefit of $48,000. But before, the taxable amount was 0. Now the taxable amount has become $40,800 because of this additional income. This additional income caused a portion of this to become taxable. So when we go down here, our tax being calculated is $9,918. And just keep in mind that the reason it's different than this is because I don't have any withholding or estimated payments in this tax return. So there's probably going to be a penalty being calculated down here. Yeah, $359. So that's the difference. That's how you get to the 10,277. But that's a different issue. The point is the actual tax number right now is 9918. So let's remember that. So here's what happened. Step 1, Social Security income. The net benefit is the $48,000. But Social Security income can become taxable up to 85% of the benefit. That's the maximum. That's where it will max out. In this case, this maxes out. This is that $40,800. That is 85% of this. So the point is that $70,000 of RMDs was enough to cause the maximum amount of Social Security to be subject to tax. So let's go down here and do the tax calculation, but I want to break it out into two parts. I want you to see the RMD alone, and then I want you to see what happens with the Social Security income. So the RMD was $70,000, and we take the standard deduction of the $25,900 against that, leaving $44,100 of taxable income. The Social Security income, I've already used up the entire standard deduction here, so there's nothing left to be used against this. Plus, I could argue that this wouldn't have even been taxable in the first place if it wasn't for that. So this is going to be 0 right here. And our totals will be, if I add these across, our totals will be 110,800 for total income, for the taxable income before the standard deduction. There's our standard deduction, so we have 84,900. Now when I go down here, I'm just going to calculate the tax on the two separate buckets just so you can really see what's happening here. So on the RMD, right, the first tranche is being completely used up by the RMD for $2,055 of tax. And then the difference between 44,100 and 20,550, that's what's left of the RMD amount. That's going to fall into the next bucket, 12%. So I have $5,292 of tax on that. And then this is all accounted for. Okay, there's a little bit of room left in this bracket right here. So some of this 40,800 is going to be taxed in that bracket, and then a little bit spills over into the 22% bracket for this amount of tax right here, $297. So that was the total income, the 84,900, which is the same as right here. And here's the tax, 9918. I just want to go back into TurboTax for a minute and make sure that we got the same number. So there's the 9918 right there. So this is something that you have to think about when we're talking about what your RMDs are going to be and what the impact is going to be on your taxable income, not just from the RMD itself. The tax on the RMD itself in this example was $7,347. But what's really annoying is that it caused your Social Security, which wasn't being taxed at all previously. Now you're looking at $2,571 of tax on this Social Security income, which wasn't even taxed before, and it was caused by this RMD, and that's how we got to the 9918. So that's an example of how the existence of RMDs is potentially another reason to consider Roth IRA conversions in your earlier years. And I would think about it like this. For every dollar you can get into a Roth in earlier years, and you still need to be rate conscious. You have to consider the other things we've talked about throughout this entire video series. It's not just getting into the Roth, but is it getting it into the Roth at a low rate based on your facts and circumstances? But considering all that, for every dollar that you can get into the Roth, that's a dollar plus all the earnings on that dollar that will no longer be in your RMD bucket in later years. When you have it in the traditional, that dollar plus all the earnings is just going to keep accumulating inside that traditional, and all of it is going to come out as RMDs. But if you can get that dollar into a Roth, not only does that dollar never have to come out as an RMD, but all the future earnings on that dollar will never have to come out as RMDs either. So the point is that we can potentially reduce RMDs and the impact that they may have causing other income to be taxed, like in this example with the Social Security, causing that to be taxed unnecessarily in later years. So it's a balancing act, and it's going to be based on your specific facts and circumstances, which can change over time. That's why tax planning is an ongoing thing. It's not just a one and done. Okay, so here is how I want you to start conceptualizing tax planning in your mind. The approach that we're going to use is to estimate what your RMDs will be in the future, and then work backwards from that to your current age, looking for Roth conversion and planning opportunities along the way. So the first thing is to estimate, what are these RMDs going to look like? Because if we can start to figure that out, and we're going to do a calculation over here about how you actually estimate that. But you have to figure out what numbers are going to go here, and then you have to figure out what other income items you're going to be having, and then we're going to work back into that Roth conversion sweet spot, trying to find opportunities to get this income out of these RMD buckets and put them in earlier years. In fact, if we go to the next tab, so here I've zoomed out on the spreadsheet just so we can kind of conceptualize the entire process. So here's where the RMDs are going to be out here in these years, and then here's the Roth conversion sweet spot. In fact, if you recall this timeline from the beginning of the video, this timeline, this is like the kindergarten version of the timeline. This just sort of shows, here's the sweet spot, here's the RMD territory out here. So we take that and we turn it into, this is like the college version as opposed to the kindergarten version. Here's the RMD territory, here's the sweet spot. And of course, if you're younger, you would have more columns here for whatever age you are at the time you're doing this. But this is what we're going to do. We're going to start here, we're going to fill in these items, and then we're going to have to work backwards and find those opportunities. So that brings us to planning example 1. So let's see what we got here. So out here in the RMD territory, I've entered in some hypothetical RMDs, and we're going to get to the actual calculation of this in a moment. But let's just assume that we've calculated it. We've actually determined what these numbers are. So I'm going to put those in, and then I'm going to put in my other income items. So let's see what Phil and Alice have going on. So here in 2023, Phil is working full-time. He's got $200,000 a year in income. Alice is working full-time. She's got $170,000 of income. They're going to plan to work for the next 3 years, and then Alice is going to retire, but Phil, he's going to work part-time for another 2 years. That's their plan. And this is what you do when you're doing tax planning. You kind of figure out, okay, when am I going to retire? How much income am I going to have each year? If I'm going to work part-time for a little while, what's that going to look like? And so forth. So that's kind of how Phil and Alice are setting up. Now, interest income, I'm just going to assume that, to make things simple, they just have $4,000 of interest income each year. They're going to have ordinary dividends of $9,000 each year for a while. We're going to think about doing Roth IRA conversions. So this line is going to be blank for the moment, but we're going to find some numbers to put in here in a minute. Inherited IRA, I'm going to leave that one out for this example, but you certainly could have income coming from an inherited IRA that would bump you up potentially into higher brackets. Social Security, we're going to leave at $24,000 for each of them as we were doing before. I have it so that they're starting their Social Security at $68,000. There's different options when people can start Social Security. And then right now, without any additional planning, here are the RMDs that Phil and Alice will be looking at as we go out into the future. So this is kind of the setup that you're going to be doing for yourself. If you want to do this kind of planning, you're going to figure this out first, then you're going to drop in things that you like, for example, Social Security. You're going to figure out when you're going to start taking that. You're going to look at your interest and dividends. You're going to look at other kinds of income. I'm going to leave long-term capital gains and qualified dividends blank for this example, but you could certainly put these in if you have them. You're going to look at your W-2s. You're going to figure out when you're going to start retiring or working part-time and so forth. And that's how you're going to kind of lay out your plan, because you've got to figure out where your opportunities are. So here's what I'm going to do. Based on this, take a good look at kind of how we've laid out this plan. We're now going to scroll down to the bottom of the spreadsheet. And for the standard deduction, I'm just going to take standard deduction, okay, for this example. We're not going to mess around with itemized deductions and so forth, but you certainly could. I would, if you do itemize, I certainly would be throwing those in here to get the most accurate number that you can. But for this example, we're just going to take the standard deduction right here. And ultimately, we get down to a taxable income figure each year. This I've summarized. We don't need to go into detail on this right now, but this is kind of a summary of the difference between ordinary and long-term capital gain. What I really want to focus on right now is this bottom section right here. These are the tax brackets. These are the rates right here. Okay, and what I want you to see, I want you to kind of take a big picture view of what you're looking at right here. And here's what I want you to notice. I want you to notice that the 24% tax bracket in these years right here, these sweet spot years, there's no tax going on in some of these years right here. This bracket is not being maximized right here. This 22% bracket, this is not being maximized in these years. In fact, income for this couple, because they retired here, Social Security didn't start till out here, RMDs didn't start till out here. They have this like gap or hole, basically. And this is a very common thing to find. If you're retiring in your early 60s, Social Security and RMDs are not starting until you're out here, you're going to find there's a lot of opportunity right here. And so when I say visualize this, I want you to like visualize this gap right here. This gap has a lot of opportunity in it to move income out of your RMD bucket, basically, and stick it into a Roth in these earlier years in order to get the advantage, the benefits of all of these lower rates. And also, let's look at another thing. I'm going to start with here's the 24%. I'm going to start with the 32% bracket. If we now scroll out into the future when RMDs are happening, what you're seeing is that this bucket, this 24% bracket, is getting used entirely, and income is spilling over into these even higher rates. Income is spilling over into 32%, and even some of it is spilling over into 35% out here. And so the goal is going to be, instead of having this gap right here, what we want to do is we want to get some of this income out of these buckets here, get them taxed at these lower rates here, so they won't be taxed at these higher rates here. It's kind of like a smoothing. It's smoothing out your income into years where you have opportunities by doing Roth conversions, or at least partial Roth conversions. So what I want you to notice right here is, here's the total tax. This just adds up all of this tax right here to get this total. And here is the total AGI of Phil and Alice from up here. When I add up all of this tax over the life of this couple right here, and then I add up all of this income, and I divide the tax by the income, the effective tax rate in this example over 25 years for this couple is 18.1%. Okay, so we're gonna do some planning now and see if we can get this 18.1% to come down. So let's go to planning example 2. All right, so in example 2, we're going to continue with Phil and Alice, and what we're going to do is we're going to try to take advantage of these years where there's not a lot of income through Roth conversions to see if we can lower our effective tax rate. And so what I'm going to do is, like, for example, when Phil is working part-time, he still has some level of income coming in. So I'm going to choose a number to do a Roth conversion with, 165 in this example. But when Phil stops working and there's less income coming in, then I may bump up the Roth conversion to a higher amount. But then in later years when Social Security starts, then suddenly income is coming in again, and so I may decrease the Roth conversion from the previous couple of years. So it doesn't always have to be the same amount. In fact, generally it won't be. You have to look at what are your other sources of income and how much Roth conversion can I do to maximize the particular bracket that I'm trying to maximize. In this case, we're going to be trying to maximize that 24% bracket, but I don't want to spill over into the next bracket either. So it's going to be kind of playing with these numbers and figuring out how much Roth conversion can I do to maximize a bracket, get the most benefit, but not spill over into the next bracket. And then conversely, by moving this income here, by shifting it over here through the Roth conversions, what I've done is I've basically taken it out of the RMD years, okay? So like, for example, I'm doing a Roth conversion over here of 165 in 2026. So I'm going to pull that. I'm going to say that that money is effectively coming out of this year right here. 165 is coming out of this year. 215 is coming out of this year. So I'm reducing my RMD bucket by getting that money, getting those dollars converted over into the Roth in these earlier years. So that now I'm filling up my Roth IRA conversion row, okay? Now, so by doing this, by filling up this gap where they don't have a lot of income, let's go down to the bottom of the spreadsheet and see what the results are. So right here, let's take a look again. Here are the brackets once again. Now, if you recall, if I go back to planning example 1, right here, there's this huge gap where there's no tax going on. 22% is not being utilized. 24% is not being utilized. When I go back to planning example 2, what you can see right here is I am now filling these brackets up. In all these years, I'm filling up the 10%, I'm filling up the 12%, I'm filling up the 22%, and I'm getting some income taxed in the 24%. There may even be more opportunity here because I'm not actually maximizing this bracket yet. So there could be even, you could even do more conversion here potentially and still stay within this bracket. Now on the other side, remember how in later years income was spilling over into the 32% and higher brackets? Well, if we scroll out here now, you can see that in those later years, I've gotten that income out of those brackets so that the income out here is not being taxed at such high rates. I'm smoothing the income basically through Roth conversions. So now when this is more even like this, when you're getting the advantage of the 10, the 12, the 22, what you're going to find is that the overall tax rate is going to go down. So let's go down here. So the effective tax rate, I'm doing the exact same thing. I'm adding up all the tax, dividing it by all of the AGI. So in example 2, which is this example right here, if I do that, the effective tax rate over 25 years becomes 15.8%. Instead of it was 18.1% in example 1. So that's a 2.2% drop in tax rates over the life of this couple. And when you put the numbers around it, total tax paid over 25 years in example 2, in this example right here, was $1,040,004 is what is being paid over the 25 years right here. But in the previous example, it was $1,186,383. So that is a difference. The decrease in tax paid over 25 years by Roth smoothing was $146,000 in this example. I mean, this is nothing to spit at. I mean, this is your money. This is your money that you're just not handing over to the government by doing some simple planning, by trying to figure out, okay, here's what I think my RMDs are going to look like, and that's the next thing we're going to do right here. Here's what I think they're going to look like, and it's too much. Like, it's pushing me into the higher brackets. And so what I want to do is and I'm also not utilizing, because of my retirement plans, because my Social Security isn't starting till here, I'm not utilizing all of these brackets the way that I could be. And so by shifting that income through Roth conversions from out here into here, I've been able to lower my effective tax rate by 2.2% over the retirement years of this family and save $146,379. By the way, if you are interested in this personal tax planning template, I do have it available for purchase along with exclusive videos demonstrating how to use it and how to customize it for your own personal situation. Your purchase helps out the channel, and it gives you a planning and analysis tool that you can use throughout your life to help minimize your taxes and maximize the cash that remains in your family's pocket. So it's a win-win for everybody. If you're interested in that, you can check that out in the description below the video. So next up, we're going to do the RMD calculation. Okay, let's hop into how do you estimate your RMDs in order to do this kind of planning. So we're going to lay out a little spreadsheet here, and let's just go through the columns. So we have the relevant year here. We have your age here. The IRS life expectancy table, we're going to pull that up in a minute, and I'm going to show you where to get these numbers that are used to determine what your RMD is going to be. Then we're going to need to know what your IRA, your traditional IRA value is on a certain date. So I've just picked 12/31/2023, but this certainly can be modified to be whatever date you want to start doing this. So I'm just going to say that Phil and Alice have an IRA value in total. I'm just going to do them in total for simplicity here of $3 million. And I'm going to put in an IRA percentage growth rate of 3% on average over time. Historically, that's a pretty reasonable amount. to estimate. This is what all your financial planners and people like that do. I mean, they have to figure out some kind of estimated growth rate if they're going to do projections over time. Obviously, nobody can say for sure what the investment return in your portfolio is going to be, especially going out for multiple years or even decades. So, you have to pick something that you think is reasonable. In this case, I'm going to use 3%. So we're going to put our IRA account value in here, and then we're going to allow it to grow by the percentage growth rate, and then we're going to decrease it by the RMDs. So this right here pulls this value that we entered down here. This pulls the percentage growth rate down here. And then so this calculates the dollar growth in a given year. 3 million times 3% is 90,000. And then we're going to calculate what the value is at the end by just taking the beginning IRA value. This would be the beginning of 2024 right here. And then the growth rate for 2024, and then the amount at the end of 2024. And then this will just continue, right? This is a very simple growth rate calculation. Each year, it grabs the balance from the end of the previous year, puts it at the beginning of the year, grows it, and then you have a new amount at the end of the year. Very straightforward kind of calculation. Now, the next thing that we need to find is right here. When your RMDs are going to start, that's age 73, you need to know what numbers to put in right here in order to calculate what the RMD is going to be. So let me show you where to get that information. Okay, if you Google IRS life expectancy tables, you will find this publication 590B. This is where I'm getting the information from. And there are 3 tables that are available. This table 1 right here is called single life expectancy, and it's for use by beneficiaries of IRAs. So this is not the one that I'm going to use for this example. There is also table 2 called the joint life and last survivor expectancy. This one says for use by owners of IRAs whose spouses are more than 10 years younger and are the sole beneficiaries of their IRAs. So if your spouse is the sole beneficiary of your IRA and is more than 10 years your junior, then you would use this table. We're not going to use this one for this example because Phil and Alice are only 1 year in age difference, so we're going to continue to find the next table. And finally, table 3, the uniform lifetime table. This is the one that I'm going to use. This one is for use by married owners. Again, that means owners of an IRA. Married owners whose spouses aren't more than 10 years younger. And then there's another category here. Married owners whose spouses aren't the sole beneficiaries of their IRA. So if your spouse is not the sole beneficiary, maybe you have multiple beneficiaries listed there, this table would be for you. If you're a married owner and your spouse is not more than 10 years younger than you, then this table is for you. So this is the one that I'm going to use for this example. I just want you to be aware that there are 3 different versions of the table, and based on your circumstances and what IRAs you're dealing with, you may have to use one of the other ones. But this is the one that I'm using for this example, table 3, the uniform life. So let me put these side by side just so you can see. All right, so all I want you to do is see, like right here for age 73, the factor that you have to use is 26.5. So here's age 73, 26.5, 25.5, 25.5, 24.6, 24.6, and so on, all the way down to the end. This table actually goes to 120 and over. We're not going to go that far in this example. What we're going to do is just go down to 100. Let me see where I stopped. Actually, for this example, it looks like I just went down to 105 just for fun, because I want you to see that the point of these factors, as these factors get smaller and smaller, the more that's going to be coming out in the form of RMDs. Like the balance in this, if I went all the way down to like 120 here, the balance in the traditional IRA would basically get really close to 0, because these are designed to get all the money out of your traditional IRAs. Now, probably, in most cases, people are not going to live to be 120. So probably what would happen is over your lifetime, you will be calculating RMDs based on this, until you reach the age where you ultimately pass. And let's just say that's 95. So at 95, what's going to happen is your beneficiary is going to inherit this balance right here. And then under Secure 2.0 Act, they're going to have to take this balance out over 10 years. And they're going to follow one of those other tables, the one for the beneficiary. And what you're going to notice when you go look at that is that over 10 years, it doesn't get the balance to zero. And so what's going to happen is it's going to be like a balloon distribution, kind of like a balloon payment on a mortgage, where for 9 years, some like smaller amount of this is going to be coming out. And then in the 10th year, it's all going to have to come out. And so your beneficiary is going to have to do some serious planning if they want to try to get, the most advantage out of this. And this is, if you are considering doing Roth conversions in order to put the most money in your beneficiary's pocket as one of your goals of doing this, getting that money into a Roth, once it's in the Roth and they inherit that Roth, then they will still have to take the money out in the form of RMDs, but there won't be any tax on it. So, it doesn't bump them up and give them a surprise tax bill in the higher brackets or in any bracket, because the money coming out of that Roth will be tax-free. So basically, this is how you do it. Oh, so let's do the RMD calc. So all I'm doing right here in this cell is what you do is you take the balance at the beginning of the year or the end of the previous year, and you divide it by the factor. And that will tell you what the RMD is supposed to be. Now, obviously, this is an estimate, because are you going to get exactly 3% return, exactly every year for the next 10 years? Probably not, obviously. So there are certainly some assumptions built into this. Is 3% reasonable? Well, nowadays, this is the end of 2023. I think you can get like 4%, maybe even 5% in some cases, risk-free on cash right now, because the Federal Reserve has been on such a tear, raising rates over the last year and a half, whatever it's been. And so, this may be a totally reasonable rate. You could get this risk-free. You can get even more than this risk-free right now. Will that always be the case over the next 10 years? Who can say? That's anybody's guess. So in any kind of estimate of what's going to be happening in the future, inherently there's going to be some built-in assumptions. What can you know for sure? Well, you can certainly know what your starting balance is. That's a given. You can look that up. You can certainly know what these factors are. You can certainly know how old you are. So the only thing that's really kind of uncertain is going to be, what is this rate? And so what you have to do is you have to decide what rate you think is going to be reasonable for your risk tolerance and your investment strategy, and et cetera, et cetera. And then you have to plug that in here. And certainly, if you were updating this, you could certainly be more aggressive. Like you could potentially have like a larger growth rate here if you want to be more aggressive with your investments, and then move into less aggressive investments down here. You could make the growth rate lower in later years. There's a lot of different options and things that you could throw into this to think about it. But the point is, you need to start at whatever age you're at. You need to grow your portfolio at whatever you think is a reasonable amount until you reach RMD age. And then once you get to RMD age, you're going to take the value in that portfolio and you're going to start taking it out following those, this is the uniform lifetime table, following whatever table you're supposed to follow for your situation, depending on the age of you and your spouse, etc. And you're going to start pulling out the RMDs. So these are the RMDs right here. And what you do then is you take these RMDs, so like this one is for 2038, you would take this number, you would go back over to your planning example, you would go to 2038, and you would drop that number in right here. See what I'm saying? You would drop that number in right here. That would be the income from your RMD. All right, I haven't linked these two together for this example because I'm doing Phil and Alice kind of just like all together for simplicity. But you would actually, what you would do is you would copy this tab right here. You would have like 3 of these, one for Phil, and then one for Alice's first IRA, and then another one for Alice's second IRA. And you would run the numbers for each one because, again, Phil and Alice will have RMDs starting at different times. So you could potentially do both of Alice's together, I suppose, but you would definitely want to separate Phil and Alice and have at least 2 of these because the age at which they will start their RMD is going to be different. Okay, so and for couples that are more than 1 year apart, there could be several years where the RMDs, one spouse will be taking the RMD and the other one won't be there yet. So this is how you set it up, just like this. And then if you were doing this, I would just link it right to these as you go out through the years, and that will help you. And then what you can do is you can continue to play around with it. You're like, well, you know, maybe my growth rate was too low. Let's see what happens if I bump that up to a 4% growth rate. Or let's see what happens if I drop it down to a 2% growth rate. And then you can say, okay, if I do that, then these RMDs change, and so the amount of Roth conversion that I'm going to do over here could be different. And so this gives you a way to think about your options and to lay it out in a format that's easy to follow and easy to understand. So let's go to, I have a couple of other things I want to talk about. Let's just go to a couple practical tips that I set up here. So I want to talk about 2 practical tips related to IRA conversions. Tip number 1, I have seen a few comments on the channel where the basic theme of the comment in my interpretation was kind of like, well, Roth conversions are good, you know, or Roth conversions are bad. Like that's kind of like a blanket general statement, like it's always good or it's always bad. And there was even one comment that made me laugh, and it said something like, you know, you shouldn't assume, talking to me, you shouldn't assume that the kids, i.e. the beneficiaries of your traditional IRA, will be in the highest brackets, like in, well, you know, when you pass and they inherit it, and they inherit the traditional. You shouldn't assume they should be in their highest brackets because these days all kids are basically couch potatoes and they're playing video games, and they probably will be in the lowest bracket during the 10-year beneficiary RMD window. And it's like, okay, so here's what I want to say about that. I believe the point to make here is that it's not that doing Roth conversions is good or bad as a general statement. Rather, it's, are Roth conversions good or bad for your personal facts and circumstances? That's what the question is going to be. So like, for example, if you have a son, he's a couch potato, he plays video games all day, he doesn't earn any money, and your traditional IRA portfolio is small enough, let's say, that over the 10-year beneficiary RMD window, your son can probably get all the distributions out and taxed at 10 to 12%. Okay, well, then, yeah, in that situation, it would not make sense to do Roth conversions now, trying to fill up the 22 and the 24% bracket if your couch potato child is going to be able to get the money out at 10 to 12%. I mean, obviously, that wouldn't make sense. So it's going to be facts and circumstances based. It's not good or bad inherently. It's, is it good or bad for your personal situation? Okay, that's what I said right here. It's not that they're good or bad. It's, is it good or bad for you? All right, so there is no right answer. The only answer is the answer that's right for your personal situation. And I would suggest framing your thought process in terms of risk. Basically, like, what is your risk for doing some partial conversions? I would think about it like this. Let's lay it out this way. The money in your traditional IRA is going to be taxed at some point. There is no avoiding that. It's either going to be taxed because you choose to take it out for some purpose, which you can certainly do, or it's going to be taxed by force during your RMD years, or whatever's left is going to be taxed by force in the 10-year beneficiary window. And after that, the traditional IRA will be empty. So every dollar will be taxed at some point. So the risk is not, will it be taxed? We know it will all be taxed eventually. The risk is, will most of it be taxed at the highest rates that are relevant to me and my family? That's kind of like the risk. It's going to be taxed. The question is, what rate can you get it taxed at? And if you can get it over into the Roth, then that dollar and every bit of earnings on that dollar will never be taxed again to you or your beneficiaries. So flipping the question around, what is the risk to you of doing some partial Roth conversions if you can find low tax rate years like we just did with Phil and Alice, and opportunities within your facts within your life, your facts and circumstances of your life? The only real risk that I can see is, will you actually end up in a lower tax bracket later? Like if you do kind of like this situation with the couch potato son, he's in a lower bracket in that example. So if you're busy doing Roth conversions to maximize the 24% bracket, and then he ends up just being in a situation where he could get it all taxed at 10 to 12%, then doing a Roth doesn't make any sense, right? So it's going to be facts and circumstances based, and the risk is, will you end up in a lower bracket, or will the income have the opportunity to be taxed in a lower bracket? Then you're not thinking about that, and you're making the mistake of getting it potentially taxed in a higher bracket. That would be the risk, as far as I can see it. And so what you have to do is assess based on your future projections of income, which is what we went through in the examples, your expectations about what rates your beneficiaries could be in, impacts of future tax law like the Tax Cuts and Jobs Act expiring at the end of 2025. We talked about that in one of the previous videos. What is the likelihood you're going to be able to get all the money in your traditional IRA taxed at lower rates in the future versus those rates that are available now in earlier years? And there's three basic ways to approach it. You can do nothing. A lot of people do that. A lot of Americans they don't do any tax planning, and they just kind of let the chips fall where they may. And, that's their choice. You can do that. The next thing you could do is you can make like blanket statements about whether Roth conversions are good or bad, and you can base your planning and decisions on that. You can do that too. You have every right to do nothing. You have every right to kind of make a blanket case that it's either good or bad, and then you can just do your planning accordingly. Or you can be proactive and try to actually figure out, to the best of your ability, what your future RMDs are going to look like, what your future rates are going to look like, what your kids' future rates might look like if you're thinking about your beneficiaries as part of this process, and then back up, sort of work backwards into what opportunities can you identify to get the money taxed at lower rates. And speaking of lower rates and higher rates and the Tax Cuts and Jobs Act, what I want to do is I want to go to this marginal rate scenario thing. And this is something that you might consider. Here, this is a very simple scenario. It looks like a lot of numbers, but I'm going to explain it real simply, okay? Let's just assume this is what the RMDs are for this particular couple over the years. Here's one person, here's the other person. There's the RMDs. They start in 2030 and they go out into the future, and that's the total amount, okay? Very straightforward. Remember when I said we have to think about tax laws changing and so forth? Well, here's the current law that's in effect until the end of 2025. So these are the brackets. These are the amounts. I'm sure in 2024, 2025, these will bump up a little bit. They always index these for inflation. So this is the 2023 numbers. But more or less, we're kind of looking high level here. More or less, this is the current law. Okay? Now, under the current law, if I have, just assuming that, let's say the current law was actually made permanent, right? They didn't, instead of letting it expire, Congress actually made this permanent, and this remained the law. Well, if this was the law out into the future and these brackets were unchanged, which we're going to get to some changes in a second, but assuming they were unchanged, just for simplicity, these RMDs would end up getting taxed here, right? They would be taxed in all of these, but the marginal rate at which they're getting taxed is 32%. So if you're thinking about risk, you're like, what is my risk that I'm going to be in a lower rate? You could set up something like this, and you can say, all right, under current law, with brackets being as they are, and these are my RMDs that I estimated using this method that we went through over here, I'm going to be in the 32% tax bracket. And so the risk of getting my money taxed at lower than like 24 in the current year or 22, the risk of getting lower than this is probably like the risk of missing out on the opportunity of being taxed lower than this. That risk seems pretty low, right? If based on my calculations and the current rates, I'm going to be in the 32% tax bracket. Here's the current law adjusted up by 50%. I grew these brackets 50% higher than they currently are down here. So for example, in the 35% bracket, instead of being 693, it's at 1,040,000, right? So here, even I grow these up by 50%. I look at the 32 and the 35% bracket. Okay, check it out. I'm almost out of those. Only like at the tail end did I actually like fall into those brackets. So you know what? I'm already like, if I think that this is the current law is going to be made permanent by Congress, and they're gonna up the brackets for inflation, and maybe by the time we get to 2030, they're going to be 50% higher than they are now. Based on all that, you know what? I'm really only in the 24% bracket, and so doing planning to try to get money out of the 24% bracket in the future and get it into the 24% bracket now doesn't really make any sense, and you're not getting any advantage of that. So if you don't think you're going to be in the higher brackets later, then maybe doing Roth planning doesn't matter. Like it's not going to benefit you if you're just taking money from the 24% bracket and putting it in the 24% bracket. That doesn't do anything for you. You have to, if you think you're going to be in higher brackets, that's when you need to get it into a lower bracket. And that's what we were demonstrating in these planning examples back here. Now, what if the current law expires, right? Here's the pre-Tax Cuts and Jobs Act brackets. Well, right here, these are the old brackets. This is 2017, but these are the old rates. Okay, so if this became the law again, right? You look at these two, but wait a second. Even down here, look at this. 25%, 28%, 33%. Like you're going to be taxed in all these brackets under the current facts and circumstances of these RMDs. So, you know, what's your risk of doing some Roth conversion in the 24% bracket? It might be pretty low. You might determine that's pretty low. I mean, it seems like it's almost a given that I'm going to be taxed in the 25, 28, even 33% brackets if the Tax Cuts and Jobs Act goes away. My risk to get some conversion done in the 24% bracket or even the 22% bracket, that risk is pretty low. I mean, that may be a really almost obvious thing to do. And then, of course, these are going to be bumped up for inflation if it goes back to this pre-Tax Cuts and Jobs Act law. So right here, I bumped them up by 100%. I said, all right, instead of 470 here, I'm going to bump it up to 941. Well, even then, look at this. I got kind of out of the 33% bracket, but I'm still getting taxed in the 25 and 28% bracket. So what's my risk of taking advantage of the 24% bracket, if I can, this year and in 2024, 2025, before the Tax Cuts and Jobs Act potentially will expire? And remember, it's an automatic expiration unless Congress acts. So if they don't act, if they don't do anything, it will expire. And 2024 presidential election and half of Congress is going to be elected at the end of 2024. You get a split Congress. I would think it's highly unlikely they're going to do anything other than let it expire. But, you know, I can't say for sure what Congress is going to do at the end of 2024. So we're just all going to have to wait and see. But the point is, if you run this kind of like what if analysis, you can say, you know, if the tax brackets go back to pre-Tax Cuts and Jobs Act, even if they're 100% higher than they were, I'm still getting hit in the 25 and 28% bracket. So maybe my risk of doing conversions in the 24 and even 22% brackets in these earlier years, that risk may be low. So here's what I want to give you. I want to give you one more practical tip, and then we're going to wrap it up. Tip number 2. Let's say you've been considering Roth conversions, but for whatever reason, you just can't seem to pull the trigger on it. You've been watching these videos, you're like, this really sounds like something I want to do, but you're not comfortable. You're not sure you completely understand the law or the ramifications. You think it would be a good idea, but you just can't quite get there. You can't pull the trigger on it. Here's an approach you might consider. I'm not suggesting that you do this. I can't give you advice to do this. I'm just saying you might consider it. Why don't you consider, perhaps, doing a small Roth conversion for your first year, like let's say $2,000 or $1,000 or some amount which you would consider to be small or low risk, right? Just convert that amount for your first year. And in my opinion, what are the benefits of doing that? Well, there's a couple here. One would be you get the Roth open and you get the first of the 5-year clocks running. There are several 5-year clocks related to IRAs. We're going to talk more about the 5-year clocks in part 4 of this video series. That's one of the things we'll be doing next. But the first clock starts when you open a Roth and you put some money into it, whether that money is through a traditional contribution or a Roth conversion. Opening it and funding it will start one of the 5-year clocks. So if you don't even have a Roth open now, that'd be a great time to just open a Roth, put $1,000 in it through a conversion. You get that clock started. The second thing is that you will kind of get to experience the process of doing a Roth conversion without feeling like you're jumping in with both feet, right? Think of it like it's kind of a trial run. Like I'm just going to do a $1,000 conversion just to get some experience with it, right? And what will happen is you'll get a 1099-R for the conversion next year, and you'll be able to put that on your tax return and make sure that the results are as you expected. And then finally, because you're already involved in doing Roth conversions at that point, you did one for $1,000 or whatever amount, felt comfortable to you, you will be more incentivized to solidify your understanding of the law and the rules surrounding this type of tax planning, because now you're already kind of like getting your feet wet, doing it. And what is the risk of doing a $1,000 conversion? In my opinion, not very much. I mean, what is the worst possible case? You end up in a lower tax rate in the future, and so you've paid a few extra dollars on a $1,000 Roth conversion. Like the risk of doing a small conversion just to kind of get comfortable with it, learn about the process, is the risk is low. So it might be something you could consider doing if you want to do a Roth conversion, but you just aren't comfortable like doing a big one. So I'm not saying you should do it, but it's certainly something you could consider. And I know people who do that just to kind of get comfortable with the whole process. So what is next? As I mentioned, this Roth conversion video series will now be 4 parts long. We just finished up part 3. Part 4 is going to be more about RMDs, the various 5-year clocks related to Roth conversions and IRAs in general, as well as making sure that you're paying tax on those Roth conversions with outside funds, especially if you're doing it under 59.5, and probably some other stuff, because there's been a lot of great comments under the videos. I appreciate all of you putting comments down there, questions and comments. They get me thinking on what other things you want to hear about in the videos. So I appreciate that. Throw any comments or questions down there. I hope you enjoyed this video. Thanks for watching, and I will see you in part 4.